Hello and welcome to the Roundup. We'll be covering off the issues of importance to accountants and advisors across the month of July. We explore a tax dispute that highlights the common misconceptions when companies make capital profits and pay these out to shareholders. We'll also look at the finalised guidance on Division 7A and unpaid present entitlements. We look at the differences between the draft and the finalised determination. July was also the first sitting month of the new Parliament, and with that came a series of bills enacting some of the election promises that were made. One of these we saw was the increase to the income test limit for the Commonwealth Seniors Health Card. Now, the increase substitutes indexation, which in line with CPI, that would have occurred on the 20th September 2022. Also of interest is the electric car discount bill. Now, this removes FBT from electric cars. Michael, how does the electric car discount work and who will be able to access it?
Yeah, and this was a policy that was announced during the lead up to the election, and so the new Labor government is introducing this, I guess, in response to that promise that they made as part of the election process. And basically what this relates to is an FBT exemption that relates to fuel-efficient vehicles, but only certain vehicles are going to qualify. Effectively, the way this has been done is the government is going to provide an FBT exemption when a car fringe benefit is provided to an employee and where that car meets certain conditions to be classified as a nil or low emissions vehicle. Now, it's interesting that the government has decided to, I guess, try and increase the take-up of electric vehicle ownership through an FBT exemption because there'll be a whole bunch of people who just don't have access to this. For example, a sole trader running their own business can't really go out and buy an electric vehicle and qualify for this because they can't employ themselves, therefore can't provide themselves with a car fringe benefit. If that sole trader had other employees, they could potentially then kind of take advantage of this. There will also be employers who are just not willing to enter into car fringe benefit arrangements because of the admin hassle that goes along with some of these arrangements. So I suspect in practice there will be, I guess, a number of people who can't or aren't willing to enter into these type of arrangements, which possibly will limit the effectiveness of this measure in terms of the take-up of electric vehicle ownership. Now, there are a few key things to take into account as we're thinking about this FBT exemption. The first one is, we need to be really careful about the type of vehicle we're looking at. Not all cars that have an electric motor in them will qualify. Generally, the way it will work is that if you're dealing with a fully electric car, it'll probably qualify. If the car utilises hydrogen fuel cell technology, it may well qualify. Certain other hybrid vehicles might qualify as well, but typically only if they can be plugged into an external source. If a car has basically a combustion engine and can also utilise petrol, it might not qualify. You need to be really careful. It's a very, very strict definition in terms of the types of vehicles that can qualify for this exemption. The second thing to note is that this is a measure designed to increase the take-up of electric vehicle ownership. If you're looking at a car that is already on the road pre-1 July 2022, it won't generally qualify for this exemption, even if the car fringe benefit arrangement starts or continues after that date. So really this is aimed at trying to encourage people who don't already own electric cars to go out and buy one. So that 1 July 2022 date is quite important to keep in mind. The other thing to keep in mind is that this exemption is only aimed at cars that have a price that is less than the luxury car tax threshold for fuel-efficient vehicles. Now, that threshold changes from time to time. At the moment, it's just under $85,000. I guess there's a couple of practical things just to keep in mind there as well, in terms of, well, how many vehicles are there out there on the market that actually fall within the scope of this provision at the moment? It's probably pretty limited. Presumably over time it will increase. There's also a bit of a wait list on a lot of vehicles around the country at the moment. So practically speaking, it could take some time for some people to actually take ownership of a car that would qualify for this exemption. Now, one of the things that we just need to be careful about with this particular measure is even though fringe benefits relating to these cars might be exempt from FBT, these benefits will still be taken into account in calculating the reportable fringe benefit amount for the employee. So no FBT where the relevant conditions are met, but the employee still needs to keep in mind that the value of that benefit might have an impact on other areas because it might be included in certain income tests in terms of other benefits, Medicare levy, that sort of thing. So important just to keep that distinction in mind as well. We have an FBT exemption, but the benefit, even though it's exempt from FBT, will still be taken into account as a reportable fringe benefit. Now, this measure is not yet law. The bill has been introduced to Parliament. We'll have to wait and see how it progresses, whether there's any amendments or not. We'll have to wait and see. But at this stage, based on what we know from the bill and the EM, that's how this looks like it's going to work. Few things to keep in mind if you've got clients who are thinking about taking advantage of this. Be really careful, particularly about the type of car, and remember that reportable fringe benefit issue as well.
July also saw the finalisation of the determination on Division 7A and unpaid present entitlements. Can you take us through what changed between the draft and the finalised determination?
Yes, so you're absolutely right. The ATO has finalised its determination on Div 7A when dealing with trust distributions owed by trusts to private company beneficiaries. Now, it's been a bit of a journey. The final determination does differ in some respects to the original that was issued a couple of months ago, and it does pare back some of the changes. Now, more than a decade ago, the ATO changed its view on trust distributions. So if a trust appoints some income to a private company beneficiary and it remains unpaid, the ATO says that's financial accommodation and that can trigger a loan under Div 7A. Now, ultimately, what that means is that can trigger an unfavourable deemed unfranked dividend unless it's appropriately managed and managed within the required time. Now, there are a couple of options. Most practitioners tend to opt for enter into a complying Div 7A loan agreement, but the other option is to put in place a 7 or 10-year interest-only subtrust arrangement. Now, we don't tend to see many subtrusts in practice because they are quite complex and often quite fiddly to manage. But for those that are comfortable and are using subtrusts, it seems like going forward that subtrust approach is just not going to be commercially attractive anymore. Now, that was the case under the draft determination, and that's remained the case under the final determination. For those that use complying Div 7A loans, there are some very strict timing rules around when a complying loan agreement needs to be entered into and when minimum repayments need to be first made. Now, we've gotten quite comfortable over these timing rules over the last decade, but the draft determination proposed to change some of those rules, some of those timing rules, at least in certain situations. Now, the ATO has gotten some feedback and they've pared back those changes. So now the approach in the final determination looks like it's quite similar, at least from an outcomes perspective, to what we're currently doing right now and what we've been doing for the last 10 years.
So Matt, there's a lot of confusion around how the timing works when we have unpaid entitlements and how we deal with that in practice, maybe with loan agreements. Can you explain to us how that timing really works in practice?
Yes, so I think that is a fair point, that some practitioners out there might still be a bit confused about the timing rules. At least from a timing perspective, the approach in the final determination is quite similar to the approach that we're currently using. So the ATO says in its final determination that if a trust makes a distribution or appoints some income to a private company beneficiary and let's say a subtrust isn't entered into, then a loan arises at the point in time which the private company beneficiary knows what its specific entitlement is. And that typically won't happen, at least with sufficient certainty, until the following income year when the financial accounts are finalised. So let's say a trust appoints some income in the 30 June 2022 income year and a subtrust isn't entered into, then a loan won't typically arise until the following income year when the accounts are prepared or finalised. Now, that essentially gives us an additional year of breathing space before we need to put in place complying loan agreements and before we need to start making annual minimum repayments. Now, the approach in the draft determination was a bit more complex. You needed to firstly work out whether the trust was appointing a fixed dollar amount or some sort of percentage of trust income, or some sort of other amount that involved a calculation. Now, the situation where that's specifically a problem is that if the trust appoints a fixed dollar amount, let's say $100 to private company beneficiary, then the ATO in its original approach said that that private company beneficiary is taking to know what its specific entitlement is almost instantaneously. And if it knows what its entitlement is instantaneously, then a loan also arises instantaneously. And if a loan arises instantaneously, as opposed to the following income year, what that means is that I've essentially lost my additional year of breathing space before I need to put in place those loan agreements and before I need to start making annual repayments. Now, the ATO has gotten some feedback on that original approach or that original draft ruling, and the feedback was, look, that dual approach was just too hard, too complex, and it was just going to create disputes in an area that you didn't necessarily want. So the ATO has gotten rid of that dual approach and gone back to an approach that, look, at least from an outcomes perspective, is at least quite similar to what we're currently using, and in most cases should give you that additional year of breathing space back.
In cases, we saw an interesting scenario play out before the AAT. In this particular case, the taxpayer representing themselves was entered into a dispute with the ATO over the tax treatment of a special dividend from a company. Michael, tell us about the dispute and the issues that it raises.
Yeah, so this was the Douglas case, and this was a case that went through the AAT, and I would be very surprised if it goes any further than this, because I think from a technical point of view, the answer in this case is actually reasonably straightforward. However, it is worth looking at because it does serve as a bit of a reminder on some really key issues that we need to keep in mind whenever we're dealing with shareholders and companies. Now, the background to this case is we have an individual who held some shares in BHP. BHP paid a special dividend, and that dividend was received by the taxpayer. It was a franked dividend. The taxpayer included the dividend and the franking credits in their tax return. Now, at some point later on, the taxpayer had a bit of a change of heart and amended the tax return to remove the dividend and the franking credits. The taxpayer's basis for doing that seems to be that they realised that this dividend was sourced from the proceeds from the sale of an investment, a capital asset that was held by the company, by BHP. So the taxpayer said, well, that capital gain, that capital profit that was made by the company, it should retain its same character when it's paid to me as a shareholder. And because the shares were acquired pre-CGT, that capital profit should therefore be exempt from tax. Now, the ATO, not long after the return was amended it again to reinstate the dividend and the franking credits, and that's where things then ended up before the AAT. Now, you might not be surprised to learn that the AAT decided in favour of the Commissioner on this one. The AAT basically said that this was a dividend, it was paid out of profits of the company, it should therefore be assessed as a dividend on revenue account in the hands of the taxpayer, and the taxpayer was entitled to the franking credits to limit, their tax exposure on that dividend. As I said, this case kind of raises a few issues that are important to keep in mind because we do see clients and practitioners sometimes getting a little bit confused in areas like this. The first thing to note is that if you are a shareholder of a company and you receive a payment from the company, you probably have to start with the assumption that that will be taxed as a dividend and will be taxed on revenue account. And there are only limited exceptions to that. The fact that the dividend can be traced back to capital profits made by the company doesn't change the character of the receipt in the hands of the shareholder. It's still a dividend. It's still generally going to be taxed on revenue account. And we've seen cases in the past that have really looked at this area in detail and basically said that we need to distinguish between the tax treatment at the company level and the tax treatment at the shareholder level. The tax treatment at the company level won't necessarily flow through to the shareholder level. Very different to when we're looking at partnership and trust situations where we do have more of that flow-through treatment. The other thing that was quite relevant here was that the taxpayer said, well, basically, because I'm receiving a dividend that relates to capital, I should be able to treat that as a return of capital. Well, the tax rules don't really work like that. When a taxpayer, a shareholder, genuinely receives a return of capital from a company, that can often be dealt with on capital account. But it's really important we determine, or really careful that we know what we're talking about in terms of what a return of capital is. When the tax rules refer to a return of capital, they're talking about a return of paid up share capital. So an amount that's been debited to the company's share capital account. When a shareholder subscribes for shares in the company, they put some money into the company that goes into the company's share capital account. When that money comes back to shareholders, it can be treated as a return of capital and can often be dealt with on capital account, subject to some integrity provisions. The taxpayer here in the Douglas case was kind of getting confused around that and was thinking that, well, because it's a capital gain made by the company, well, I can therefore treat it as a return of capital in the hands of the shareholder. That's not how it works. We're dealing with two quite different things. Now, where we see taxpayers often getting confused around this as well is particularly when a company has made a capital gain on sale of an asset and that gain has qualified for an exemption or concession, maybe the small business CGT concessions. And taxpayers, shareholders, will often feel like they should be able to get their hands on that money tax-free. It was tax-free in the company, surely it should be tax-free in my hands as well, or at the very least should be treated as a capital amount. Again, we need to be really careful because that's not the way the tax rules work. The fact that something was tax-free in the hands of a company does not automatically mean that it's tax-free in the hands of a shareholder, and in fact, often it won't be. There are limited exceptions. There are limited cases where that can be the case. For example, when we have companies that are using, say, the small business retirement exemption or the small business 15-year exemption, there will often be opportunities to pay out exempt capital gains in a tax-free manner to shareholders. But there are really strict rules around that. Aside from that, probably the main exception and where we can sometimes treat amounts going to shareholders as capital is when a company is being wound up. When a company is being liquidated and the liquidator pays out exempt capital gains or other amounts that don't represent income of the company, sometimes as a shareholder you can treat that as a capital amount and apply things like CGT concessions to that amount. But there are really strict rules around that and we need to be very careful as we work our way through that process. So general rule, money you get from a company as a shareholder typically going to be taxed as a dividend unless it is a return of paid up share capital or unless a specific provision allows you to treat it as tax-free in your hands. That was certainly not the case here when it came to the Douglas situation.
So are there any other lessons that can be learnt from the Douglas case?
Yeah, I think there's probably two other things that are worth just bearing in mind with this case. The first one is, if we look at the facts of the Douglas case, there's an interesting little thing that happened, and that is that this taxpayer was given the opportunity to participate in a share buyback that was undertaken by BHP. Now, I don't know the full details of that particular share buyback arrangement, but it's quite possible that the tax outcome could have been different had they participated in that buyback. Now, when a company undertakes a share buyback, there are very specific tax rules dealing with that. And we need to know whether we're dealing with an on-market buyback or an off-market buyback. Those two things have very different tax consequences. An on-market buyback can really only happen when you're dealing with a listed company and it's buying back shares from shareholders in the ordinary course of trading on the stock exchange, basically. When that happens, the shareholder will often be able to treat the proceeds as capital proceeds. So had that been the case for Douglas, had that been an on-market buyback and the shares were pre-CGT shares, they potentially could have had a tax-free amount. Now, again, I don't know whether this was an on-market buyback or not, but just by way of example, that's how it could have played out. Now, when we're dealing with an off-market buyback, so a private company undertaking a buyback, or where a listed company is not undertaking an on-market buyback, then the tax outcome is often quite different. And we need to determine the dividend component of the buyback proceeds and the capital component. The way it generally works is that only the portion of the buyback proceeds that's debited to the company's share capital account can be treated as capital in the hands of the shareholder. The rest will normally be taxed as a dividend, potentially franked, but taxed on revenue account. So an interesting little kind of side point to this case is maybe things could have been different had the taxpayer participated in that buyback rather than having received that special dividend later on. Now, the other thing to point out briefly is that it appears in this case that the taxpayer represented themselves before the tribunal. Now, I haven't done any scientific analysis on this, but just from what I see. The success rate for people who represent themselves before the tribunal, particularly, tends to be pretty low. Those people who don't represent themselves and engage someone who's an expert in the tax system to represent them tend to have higher success rates. Part of that is probably because having engaged an expert, the expert might have said, you've got no chance, this is not the way to go about it. And so maybe some of those cases just end up not coming before the tribunal in the first place. The ATO has a team of lawyers behind it. The taxpayer is at a serious disadvantage if they walk in front of that tribunal without their own representation, and particularly expert representation on the matter at hand. When you're approaching tax disputes with the ATO, you need to look at that from a very technical perspective. Often what taxpayers do when they represent themselves is they kind of go with gut feel and how something should work rather than focusing in on the specifics of the tax system and the legislation. And that's often the shortcoming. Often they just don't have the technical detail in their arguments to be able to sustain the position that they're trying to argue. So a bit of a warning out there. Look, if you've got a client who wants to enter into a dispute with the ATO, wants to take things further, we really need to seriously consider whether they should be engaging experts who can assist them through that process. Maybe stop them if there's no point in going any further, or if they are going to go further, at least give them some chance of success. As I said, success rates for people who represent themselves tend to be pretty poor. So a couple of other things just to kind of take out of that case, even though the outcome itself seemed relatively straightforward, I think anyway, it's still an interesting case because it does raise some things that do come up quite a lot in practice.
The tax treatment of share trading and investing is a common area of misunderstanding. Join Michael Carruthers on the 1st of September for a special webinar exploring the issues and stepping through the approach to take. Go to Knowledge Shop's website, knowledgeshop.com.au for more details. And that's the roundup for this month. If you're a member of Knowledge Shop, jump onto the member website now and you can download those year-end checklists to help you with your compliance work. If you're not a member, then give the team a call on 1300 378 950. We'd love to show you how we help thousands of accountants make life just that little bit easier every single day. Give the team a call and we'll look forward to speaking to you soon.